All right, let's jump right in. If you, your company, or frankly, anyone you know is planning to borrow money in the next few years, you really need to listen up. There is a massive shift happening in the credit markets for 2026, and it's a story that you're probably not hearing enough about.
So, what's coming? Is it going to be this massive boom we've all been hoping for? Or that devastating bust that everyone seems to be terrified of? Well, for 2026, the answer is actually a whole lot more interesting than that. Yeah, the reality is it's neither of those things. We're not looking at a rocket ship to the moon or a plane crashing into the ground. The best word, the one that really fits what's coming, is a reset. It's this really subtle but, man, incredibly profound shift in how the whole world of lending is going to work.
So, what is this reset? What does it actually mean? Well, at its core, it's a fundamental change in how lenders look at risk. And sure, the days of super low interest rates are over. We all know that. But this goes way deeper. We're talking about the end of easy credit. You know, that time when a great story and a good pitch could often get you the money you needed? Yeah, those days are over.
Okay, so let's dive into our first section here and really break down what this reset looks like in the real world. You know, I absolutely love this quote because it just nails the change perfectly. Think about it. In the past, when the economy was booming, that rising tide lifted everyone out, right? Even the companies that were, let's just say, a little leaky. But now, oh, it's a different story. Lenders are checking the seaworthiness of every single boat. They're putting every borrower, every single deal under a microscope to see if it can truly stay afloat on its own. And that change in thinking, that new level of scrutiny, well, that leads us right into our next part, the new lending playbook. Because believe me, the rulebook for getting a loan, it's been completely torn up and rewritten. Okay, so what are the new rules of the game? Let's break them down. Number one, slower approvals. I mean, way slower. Lenders are digging deeper than ever before. Two, reduce leverage. They want you to have more skin in the game, a bigger cushion. Three is wider pricing. Now, this is a big one. The market is splitting. If you're a top-tier borrower, you're fine. But for everyone else, your cost of borrowing is going up. And finally, number four, tighter documentation. Remember those covenant-light deals where you had a lot of freedom? Yeah, kiss those goodbye. Lenders are locking everything down now. So, of course, this leads to the big question, which is our third section here. Why? Why has everything changed? This isn't happening just because. Lenders are reacting to some very, very real pressures out there. So, let's get right to it. What's actually causing this whole market reset? Okay, there are really 5 big things pushing this change. First up, credit spreads are super tight. That's the lender's profit margin, right? When it's razor thin, they just don't have the stomach for risk. Second, you've got all this uncertainty around interest rates. Are they going up, down, sideways? Nobody really knows. And that makes lending long-term a huge gamble. Third, we're seeing some economic headwinds. The economy's cooling off, the labor market is softening, it's making people nervous. Fourth, the private credit market, which has been just massive, is growing up, and that means it's facing way more scrutiny. And last but not least, you've got these huge structural forces, like the race for AI dominance, which is just sucking up unbelievable amounts of capital. All right, so that's all the high-level stuff, the why, but what does this actually feel like for a borrower on the ground? Let's walk through a few real-world scenarios. This will make it crystal clear. Okay, scenario 1. Let's say you're a property developer. In the old days, you'd expect to refinance your building at, say, 65, maybe 70% of its value. No problem. But now, in 2026, the lender comes back and says, sorry, we're only comfortable at 50 to 55%. All of a sudden, bam, you have this huge, unexpected capital gap you have to fill. The deal is in jeopardy, not because your building is bad, but because your expectations were stuck in the past. Or how about this one? You're a corporate borrower, and you need a loan to expand. You send in your application with a property valuation that's like 18 months old. You figure, hey, it's close enough. Well, in today's world, that application gets thrown in the trash immediately. It tells the lender you're not paying attention, that you don't get the new risks. And just like that, your credibility is toast before you've even had a real conversation. And don't think this is just for small guys. Even a wealthy family office gets hit. You might think, hey, I've got this big portfolio of stocks, getting a loan against it will be a piece of cake. But the 2026 lender is obsessed with one thing, liquidity. How fast can they turn that asset into cash? So they'll look at your portfolio, cherry-pick the big blue-chip stocks they can sell in a heartbeat, and ignore everything else. You end up getting way, way less money than you were counting on. Okay, I know this all sounds a little doom and gloom, but it's really not hopeless. Far from it. The key, the absolute secret, is preparation. Borrowers who get these new rules, they can actually do really, really well.
And this quote right here just says it all. Hope is not a strategy. You can't just cross your fingers and hope for the best anymore. You have to operationalize your preparation. You have to build a bulletproof case that proves you're a safe bet in this brand new world.
So, what does that preparation actually look like? Well, think of this as your 2026 survival guide. First thing, update your valuations now. Outdated numbers scream I'm hiding something. Second, reduce your leverage ask. Don't go in asking for the moon. It just signals you don't get the new reality. Third, perfect your data room. Make it flawless. A sloppy, disorganized submission makes them think you're a sloppy manager. Fourth, assume everything will take longer. Start your process 3, even 6 months earlier than you think you need to. And finally, prioritize and highlight your liquidity. Show them you have cash on hand. It proves you can survive a storm, and that makes you a much more attractive borrower.
Look, at the end of the day, it all comes down to this one big mindset shift. For the longest time, credit was just a commodity, right? You just shop around for the best price. Well, those days are gone. In 2026, it's not about a transaction, it's about a partnership. A partnership that has to be built on total transparency and rock-solid preparation.
The rulebook for borrowing has been completely rewritten. The game has changed. And in 2026, winning is going to come down to one thing: who understands these new rules and who shows up ready to play. So the only question left for you is, are you ready?